What's going on, everybody? Liam O'Reilly, Vermont Economic Realtor. Hope you're doing well. First of all, I apologize for not posting a video in the past 10 days or so. I was on vacation. I know I said I would do a better job at posting when I was on vacation, but I was just busy from sunrise to sundown. Didn't have time or energy to make a video. So I apologize for that, but let's get right into today's video. So basically, the CPI numbers came out better than expected. The headline CPI dropped by 0.1% month over month, which is encouraging. But if we look at some of these other articles, like this Forbes article, Fed hike likely despite encouraging inflation numbers. So I wanted to talk today, first of all, why that is, and then also why the mortgage rates have dropped today, despite a Fed hike being likely. So let's get right into it. So I'll leave this article in the description for you folks. He has some good points, but I don't necessarily agree with his points on housing, and I wanted to, kind of piggyback off of this headline because it's what I think is going to happen as well, and dive into the CPI numbers here. So here is the CPI spreadsheet. Now, the headline CPI is this all items category over here. So when we go all the way to the right, seasonally adjusted percent change minus 0.1%. Now the unadjusted percent change month over month down 0.3%, which I thought was pretty interesting. The thing is that the Federal Reserve doesn't put a lot of weight on this headline CPI number. Although it's good news, it's good for us as consumers, it doesn't mean that the Federal Reserve is going to see that 0.1 decrease on a month over month basis and use that to stop their course and stop raising rates. If we come down to here, all items less food and energy, that's what the Federal Reserve puts the most weight on when they make these decisions of whether or not to hike rates, how much to hike rates. And if we look at the past few months, so these past three categories are the three most recent months, with this 0.3 category being the month over month change from November to December. So it went up 0.3% in the all items less food and energy category, which is pretty much the same. It's basically the same amount of inflation that we've seen over the past 3 months where the Federal Reserve has continued to hike their rates. So 0.3%, 0.2%, and then, of course, the most recent one, 0.3%. So what I think is going to happen is the Federal Reserve is going to look at this data and say, what our hikes are not affecting what we want them to affect. The unemployment rate is still low. CPI core inflation is still at 5.7% year over year, and it's still rising at the same rate that it was the past few months here, albeit it's not these rates annualized are not extremely extremely high. It's not going to be 0.3% annualized. We're looking at 3.6% inflation year over year. It's not that 5.7%, but it's still higher than what the Federal Reserve wants. So I think they're going to look at this data and say, we need to continue with our rate hikes. But despite that, the Federal Reserve Fed funds rate right now is at between 4.25 and 4.5%. 10-year Treasury sits at 3.5%. They're gonna, even with the CPI data, I think they're likely to hike it to 4.5 to 4.75%. Obviously, I'm not the only person who thinks that. And mortgage rates still fall. The 10-year Treasury sits at around 3.5%. So why is that? Mortgage rates right now under 6%. This is New England Federal Credit Union's website. Right now, their best 30-year fixed rate product is at around 5.9%. So what is going on? Basically, the Fed funds rate, if you're unfamiliar with it, it's a guaranteed overnight rate. So you're guaranteed to get that 4.25 to 4.5% overnight. The Federal Reserve will pay institutions that to keep their cash at the Federal Reserve for that overnight period. The 4.5% is annualized. You don't get 4.5% each night consistently, night overnight. It's on an annualized rate, but it's guaranteed. You're guaranteed to get that rate, and you get your money back the next day. So it's about as risk free as you can get. You don't have to have your money tied up in anything for an extended period of time. Now, the U.S. Treasuries are risk. They're probably the next uh, lowest risk asset that you can buy, where the government, the United States government, is guaranteeing that that they're going to pay you back at that 3.5% rate, and you can they're essentially as good as cash as well. You can liquidate them easily, and they're just a safe investment. So why would institutions choose to purchase a 3.5 a U.S. Treasury at 3.5% when they can get essentially a safer investment at the with the Federal Reserve at 4.25 to 4.5%? What I think is going on, what I mean, look, I know there's people that understand these institutions and how these institutions work better than I do and can explain it better than I do, but when when I think about what these institutions are doing when they're trying to get this rate of return and what they're betting on, essentially, I think they're betting that the Federal Reserve is going to lower their Fed funds rate in the future because the you know the overnight rate, that 4.25 to 4.5%, is a very easy, it's a great it's a good return for essentially a risk-free investment that you're going to get back overnight. But if the Federal Reserve drops their rates, say all of a sudden we enter into a major recession and the Federal Reserve brings their rates down from 4.5% down to zero, now all of a sudden that's your overnight rate. That is the rate of money that you're not getting any money for keeping your money with the you're not getting any interest for keeping your money with the Federal Reserve. Whereas if you're an institution and you buy into a U.S. Treasury with a 3.5% yield, you're going to get that return regardless of what the Fed funds rate does into the future, because that's what you purchased the U.S. Treasury at, if that makes sense. So what I think is going on with that inversion is the institutions are preferring to have their money in U.S. Treasuries, which are fairly liquid and are they're guaranteed that return for a 10-year period, as opposed to the Fed funds rate and that overnight rate, where they are only guaranteed that rate until the Fed adjusts it either higher or lower. If it goes higher, then it works out in their favor and they're getting a higher rate of return. But what I think is going on is institutions are betting that the Federal Reserve is going to lower rates at some point in the near future or near-ish future. So how does that affect mortgage rates? I think a lot of these institutions, when they're looking at where to put their money and where to put their assets, they look at all of these different assets as the Fed funds rate. They look at treasuries, and they also look at mortgage-backed securities. And with what's going on in the housing market, with housing prices, housing prices coming down a little bit, but really housing transactions are staying very low because affordability is at a historic low. Inventory is at a historic low, pretty much, in a lot of markets. There's not that many mortgage-backed securities being issued. And on top of that, the Federal Reserve has also stopped purchasing mortgage-backed securities, which when interest rates were low, like over the pandemic at a 2.8% that some people are locked into, the Federal Reserve was a large purchaser of those mortgage-backed securities. So it didn't really matter what rate of return they got, because they are not in the business of making a ton of money. That is not their job as an institution, is to make a return for their investors or for their shareholders. Whereas institutions and individuals, their job is to I'm not their job, but if you're an individual, it's not your job to make a return, but your goal is to make a return. You want to make the best return possible. So when interest rates are at 2.87% or whatever, that's not a great rate of return for individuals or institutions. But now, as these institutions look around And, even though the Fed funds rate sits at 4.25 and, between 4.25 and 4.5%, they take a look at the U.S. Treasury market and they see that it's sitting at 3.5%. And now all of a sudden they might start to take a look at mortgage-backed securities as another place to park their cash and invest in that asset, because overall, historically speaking, obviously there were some issues with mortgage-backed securities in the great financial crisis, but overall, people tend to pay their mortgage. People don't want to get kicked out of their home. So, it's not as safe as U.S. Treasury. It's not as safe as the Fed funds rate, which is why there's a premium attached to these mortgages at, sitting at 5.8%. But I think more investors are starting to go over and purchase these mortgage-backed securities, which drives the interest rate down, if that makes sense. I think it does. And because inventory is low, because demand is low, there's not that many mortgage-backed securities being issued. So the competition to purchase these mortgage-backed securities is what drives the interest rate down. Because investors, if there's more investors fighting for the same product, they're going to take a lower and lower return to beat out their competition. Okay. So let me know what you guys think. Liam O'Reilly, Vermont Economic Realtor. I hope you're doing well. First video back in a little while. Leave me a comment. Let me know if you agree with me, if you disagree with me. All my contact information is listed below. If you're looking to buy or sell a home here in Vermont, I'd be happy to help you. If you're looking in another state, I would be happy to help you find a great realtor. Other than that, I will see you guys in the next video. It's good to be back.